Jim Rickards has warned that the financial landscape is set for a major upheaval. The best-selling author and investment banker predicts that 2024 will be a devastating year for stocks, as, in his view, the market could decline at least 30% due to a recession alone, and things could get much worse if either the Ukraine or Israel war escalates or a global financial crisis emerges. In this scenario, Rickards believes, stocks are expected to perform poorly, potentially losing up to 50% if geopolitical conflicts escalate. If Rickards' prediction unfolds, it will be the biggest fall in the S&P 500 since the dot-com crash of 2000 to 2002. All of this means that the US Federal Reserve will be unable to achieve a soft landing scenario, failing to bring inflation under control while avoiding recession in the US economy. Rickards expects that recession at home will lead to a global recession, suggesting that the economic challenges are significant and may impact countries worldwide. In his words, "My overall forecast is that 2024 will be more tumultuous and shocking than 2023." With a track record of accurate predictions, including Brexit and the Trump presidency, Rickards' insights are not to be ignored. His predictions for 2024 suggest a seismic shift in global markets, with significant implications for investors. In this video, we'll cover the reasons why Rickards is making such bold and damning predictions for the economy and the strategies Rickards recommends you follow to protect and grow your money during such economically challenging times. So, let's get started. According to Rickards, the US economy is on a tightrope with several factors contributing to what he believes could be an imminent collapse. At the time of creating this video, US national debt stands at record levels of over $34 trillion, which, for context, is a staggering $267,000 per US taxpayer. And Rickards points to this ballooning national debt as a ticking time bomb set to detonate. With each passing year, the debt-to-GDP ratio worsens, signaling a country living far beyond its means. So how is it possible for a country to get into such high levels of debt? To explain this, let's use the example of John. John has a young family that he needs to provide for. He works a steady job and earns an average salary, but John has a lot of bills to pay, such as daycare fees and new clothes and toys for his growing family. To help out with the bills, John gets a credit card with a $10,000 limit. John starts using his credit card to cover various expenses such as groceries, utility bills, and daycare fees. At first, John pays off his credit card in full each month, but over time, the bills rack up, and soon he opts to instead only make the minimum payments each month. While this helps John to get by and continue spending, it means he's racking up large amounts of interest on his outstanding balance each month. Within a year, John's balance reaches his credit limit of $10,000, and his interest on that balance is significant. Unfortunately, a few weeks later, John's car breaks down and needs some expensive repairs. John needs his car to travel to work, but he's not earning enough each month to pay for the car repair and all his other expenses. To solve the problem, John calls up his credit card company and requests a credit limit increase. However, as John already owes a large sum of money plus interest, his credit score is low and the credit card company refuses to increase his limit. This puts John in serious trouble as he can't get to work without a car, but he doesn't have enough money or credit to pay for the repairs. While this is a simple example of how an individual can stack up a large amount of debt in a short time, the same can be applied to the US government. The government has expenses it needs to cover each year for things such as Social Security, education, highway maintenance, and military equipment. In addition, the government has spent significant sums in recent years to try and stimulate the economy following the global pandemic. The government earns income in the form of federal income tax, but when the government is spending more than it earns, a budget deficit results. Put simply, more money is going out of the government than is coming in. To pay for this deficit, the federal government borrows money by selling marketable securities such as treasury bonds, bills, notes, floating rate notes, and treasury inflation-protected securities. all of these securities pay interest to its investors, which the government must pay. The national debt is the accumulation of this borrowing along with associated interest owed to the investors who purchased these securities. As the federal government experiences recurring deficits, which is common, the national debt grows. While it is not uncommon for governments to borrow money to finance spending, as you can see from this chart, the US national debt has grown significantly over the last 40 years or so. Adjusting for inflation, US national debt has increased from $4.2 trillion in 1983 to $33.17 trillion in 2023. That's an almost 700% increase in only 40 years. Now, in theory, that level of debt could be sustainable if the US economy's output grows at an equivalent rate. However, as you will see, this is far from being the case. To review how sustainable a country's level of debt is, economists compare a government's level of debt to that country's gross domestic product, or GDP. GDP essentially measures the output of an economy, or, put another way, the total value of all goods and services produced by the economy in a year. In 1980, US debt to GDP stood at 35%. In 2000, it had grown to 58%, but in the last few years it has shot up to record highs, reaching 123% in 2023. In other words, the US government now owes way more money than it earns. Just like in the example of John's credit card debt, lenders, including other countries, investors and financial institutions, use the debt to GDP ratio as an indicator of a country's creditworthiness. A lower ratio typically suggests a stronger ability to repay debts and may result in lower borrowing costs for the government. Conversely, a higher ratio, like the US currently has, may lead to higher borrowing costs as lenders demand higher interest rates to compensate for higher perceived risk of default. And right now, the US government is spending over $800 billion on net interest each year. As a result, high levels of debt relative to GDP can constrain a government's ability to respond to economic downturns or emergencies through stimulus spending or tax cuts. As to do this, they would need to borrow even more at increasingly high interest rates. This can hinder long-term economic growth by crowding out private investment, reducing productivity, and increasing the likelihood of financial crises. And this is why Jim Rickards is so worried about the US economy. In his words, "Our debt to GDP ratio is out of control. That debt overhang is the biggest single problem in the financial landscape." Rickards believes that the debt burden could exacerbate economic challenges and hinder recovery efforts in 2024, leading to an economic crisis. Now, before we move on to the other factors that Rickards believes are contributing to an imminent economic collapse, please don't forget to click the subscribe button if you want more weekly updates on how to build massive wealth, even in market downturns. Okay, moving on. Rickards believes that the US Federal Reserve will be unable to execute a soft landing scenario for the economy in 2024. Stating that the Fed's ability to navigate the delicate balance between managing down inflation and avoiding a sharp economic downturn is limited, potentially leading to a recession. This is because the historically high levels of national debt are stopping the government from being able to prevent economic downturns or emergencies through stimulus spending, as to spend more would involve borrowing even more, further exacerbating the debt crisis. Rickards points to rapid inflation that began in 2021 and is still not fully under control as being key to preventing any sort of soft landing. Headline Consumer Price Index, or CPI, was 3.1% in January. That compares to 3.1% in November 2023 and 3.0% in June 2023. In other words, inflation has not gone down like the Fed hoped, and Rickards believes it will stay elevated in part due to higher oil prices lately driven by geopolitical concerns. In Rickards' view, while the Fed will not raise rates soon, they also will not be quick to cut them given continued inflation, as lowering interest rates may fuel inflationary pressures. Progress on inflation has stalled, raising doubts about achieving a gentle economic slowdown and putting the economy in a position of high uncertainty. In addition, these concerns in the US economy come against a global backdrop of recession in Germany, slowing growth in China and near-recession conditions in Japan and the UK. Rickards also points to growing geopolitical tensions, such as the war in Ukraine and the conflict between Israel and Gaza, as adding to the chances of economic turmoil on a global scale. All this means that Rickards predicts that 2024 will be a disastrous year for stocks. He has stated that the market could decline at least 30% due to a recession alone, and as much as 50% if either the Ukraine or Israeli war escalates or a global financial crisis emerges. These significant fluctuations in asset prices will impact both stocks and bonds. So given these chilling predictions, is there any hope for investors in 2024? Well, despite the grim outlook, Rickards does provide some investment recommendations for navigating these turbulent times, suggesting a number of strategies you can follow that will allow you to make money in 2024, even if his many concerning predictions come true. Strategy 1. Hold cash. When it comes to market crashes, one of the best go-to strategies is to hold cash. Now, you might be wondering why cash is king during turbulent times? Well, think of it this way. When the market takes a nosedive, prices of stocks often plummet. Having cash on hand will allow you to seize incredible buying opportunities when others are selling in panic. Whether it's buying shares of strong companies at discounted prices or investing in undervalued sectors, cash gives you the flexibility to capitalize on these opportunities when others are fleeing the market. By holding cash, you can resist the temptation to chase after every market trend or hot stock. Instead, you can wait patiently for the right opportunities to come along, knowing that you have the financial firepower to act decisively when the time is right. So, if you're looking to position yourself for success as an investor, don't underestimate the importance of holding cash. It could be the key to profiting from market crashes and building long-term wealth. Strategy 2. Invest in US government securities. Jim Rickards believes that 2024 will be an excellent year for US government securities as they offer safety and stability. US government securities, such as Treasury bonds, are considered one of the safest investments globally. This is because they are backed by the full faith and credit of the US government, making them a reliable choice for risk-averse investors. Hedging against market volatility. Amid geopolitical tensions, market volatility, and potential economic challenges, US government securities act as a hedge. When stocks and other assets experience turbulence, Treasury bonds tend to remain stable. Interest income. Treasury bonds pay regular interest, known as coupon payments. Investors seeking consistent income can rely on these interest payments even when markets are down. And if interest rates drop, as some expect them to in 2024, the price of existing bonds will rise. This is because their fixed interest payments become more attractive compared to newly issued bonds with lower rates. Diversification. Including US government securities in a diversified portfolio helps balance risk. They often move inversely to stocks, providing stability during market downturns. Flexibility. Treasury bonds are highly liquid, meaning they can be easily bought or sold. This gives you great flexibility, allowing you to quickly react to market changes or potential buying opportunities. It is for these reasons that Rickards strongly advises investors to focus on Treasury notes in 2024, as interest rates are predicted by many to decline in the coming year. In particular, Rickards recommends investing in 2-year notes because 2-year notes are very liquid, less volatile, and you currently get a higher interest rate on them than, say, a 10-year note. Strategy 3. Invest in the energy, defense, agriculture, and mining sectors. Jim Rickards has identified the energy, defense, agriculture, and mining sectors as potential outperformers in 2024, even in a falling market. Let's explore the reasons behind this prediction. For the energy sector, Rickards states that the ongoing geopolitical tensions, such as the Russia-Ukraine conflict and Middle East instability, may impact energy markets. Energy companies involved in oil, natural gas, and renewables could benefit from supply disruptions and increased demand, pushing up energy prices and improving their profitability. The geopolitical uncertainty should also benefit the defense sector. Geopolitical conflicts and military tensions create demand for defense equipment and technology. Defense companies involved in cybersecurity, aerospace, and military hardware production may see increased orders, particularly as the current uncertainty is causing governments worldwide to allocate significant budgets for defense. In the agriculture sector, as populations grow, demand for agricultural commodities like wheat, corn, soybeans, and livestock remains strong. Companies in this sector may benefit from rising prices due to the continued high demand for their products. As global populations grow and resources become scarcer, these sectors are poised for significant gains. Finally, the mining sector provides essential raw materials for various industries. Metals like copper, iron ore, and rare earth elements are critical for infrastructure, technology, and manufacturing. In addition, precious metals like gold and silver are considered safe haven assets. When economic uncertainty rises and interest rates decline, investors seek refuge in these metals. Their intrinsic value and historical stability make them very attractive investments during turbulent times. So, there you have it. In the shadow of an impending economic collapse, Jim Rickards offers a beacon of hope. By understanding the forces at play and strategically positioning your investments, you can not only shield yourself from the fallout, but also find prosperity in the turmoil. Remember, the greatest opportunities often arise in times of crisis. And if you want to learn more about how you can maximize your investment opportunities during a recession, head on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.